मैंने गाड़ी ली थी वहां पे पहले।
Let us see our next question. K Ltd currently operates from 4 different buildings and wants to consolidate its operation into one building, which expects to cost an amount of rupees 90 crore. The board of K Ltd had approved the above plan and fund the above cost. And to fund the above cost, agreed to avail external commercial borrowing of 10 million pound from G Bank Ltd on the following conditions. The loan will be availed on April 1st, 2019 with interest payable on half yearly rest. Average loan maturity life will be 3.4 years with an overall tenure of 5 years. Upfront fees is 1.2%. The interest cost is Great Britain pound 6 months LIBOR plus margin of 2.5%. The 6 months LIBOR is expected to be 1.05%. K Ltd also entered into pound rupees hedge at the rate of 90 rupees per pound to cover the exposure on account of the above external commercial borrowing loan, and cost of the hedge is 4% per annum. As a finance manager, given the above information and taking 90 rupees per pound, first calculate the overall cost both in percentage term and in rupees term on annual basis. Second question, what is cost of the hedging in rupees term? If K Ltd wants to pursue, highlight the portion, an aggressive approach, what would be the net gain or loss for K Ltd if the rupee depreciates or appreciates against pound by 10% at the end of the 5 years? Highlight the portion, at the end of the 5 years, assuming the loan is repaid in pound at the end of the 5 years. Highlight the portion, ignore time value of money and income tax, and you are required to make the calculation up to 2 decimal points. That is the question. I request all of you to go through the question, then we are going to understand that how to make calculation of answer. First of all, let us have understanding of the question. Information is provided to us that K Ltd, so of course we understand looking to the information that K Ltd is an Indian company which operates from the 4 different buildings, wants to consolidate its operation into a single building which is expected to cost an amount of 90 crore, that is an amount of rupees 9,000 lakhs. Board of directors of the company had approved the above plan and fund the above cost. And to fund the above cost, agreed to avail external commercial borrowing of 10 million. 1 million is equal to 10 lakhs. So over here it is 100 lakhs pound. 10 lakhs into 10. The loan will be availed on April 1st, 2019 with interest payable on half yearly basis. Dear students, the interest is supposed to be paid on half yearly basis does not have any significance. Why? Because we are required to ignore the time value of money concept over here. So whether it is the yearly payment or it is half yearly payment, it does not make any difference. Average loan maturity is 3.4 years and overall tenure is 5 years. So the loan has been taken over a time period, that is say for the time period of 5 years. However, taking into account the actual cash flows occurring at different point of time, So the average loan maturity is 3.4 years. This is the concept that say you study in your foundation or in your CPT, that is say the concept of the average due date. In that, say you might have studied something like this, that say we purchased the raw material from the supplier at the different dates. We are having say the different credit period say for purchase of the raw material. We would like to know that a single date on which we can make all the payments, so that say we do not have to pay any interest. Similar to that, say information is given that say the average loan maturity is 3.4 years. So taking into account the repayment of the loan schedule, this 3.4 years ready-made information is provided to us. Upfront fees is 1.2%, that is a simple loan processing charge. Interest cost is given as 6 months LIBOR plus 2.5%. Dear students, we have understood it very clearly that whatever the rate of interest is given to us is always the per annum rate of interest. So the rate of interest is LIBOR plus 2.5. LIBOR is provided to us as 1.05. So 1.05 plus 2.5, overall rate of interest will be 3.55%. That is the way the rate of interest is provided to us. Say the example, it is 3.55%. Okay. The question is providing further information. K Limited also entered into pound rupee hedge at the rate of 90 rupees per pound, in a way that say we are going to have the repayment of the loan at the fixed rate, that is 90 rupees per pound, irrespective of the exchange rate prevailing over this time period. And for that, say we are required to pay the hedging charges of 4% per annum. And the cost of hedge is very clearly provided, 4% on per annum basis. And with that, so the questions are provided to us. The first question is very simple. Calculate the overall cost in percentage term, at the same time in rupees term on annual basis. That is a question. So let us understand and say how to make the calculation of answer. So answer of the first question, calculation of cost in annual percentage term. Dear students, it is very simple. We understand it is the interest cost which we are required to pay every year. It is LIBOR plus 2.5%. LIBOR is 1.05 plus 2.5, so it comes to 3.55, plus cost of hedging. Again, it is provided to us say in the annualized term, that is 4%. In addition to that, so there is one more expense, and that expense is provided to us as the upfront fees. Dear students, we understand that the payment of the interest is on annual basis. The payment of the cost of the hedging is again on annual basis. However, so the upfront fees is required to be paid only for once. So it is required to be say amortized over the time period of loan. So plus upfront fees. So what will happen, it is 1.2% divided by number of years. That is the way it is required to be converted into annualized term. So 1.2 divided by 3.4 years. Because we understand that over here we are required to amortize it over the average maturity life of the loan, that is 3.4 years. So please use your calculator. 3.55 plus 4, that is 7.55, plus 1.2 divided by 3.4, So 0.3529 or 0.35 because we have to do answer into 2 decimal. So it is 7.90%. This is the way the cost in the annual percentage term can be calculated. Now the first part of the question itself is going on, in which calculation of overall annual cost in rupees term. Now its calculation is again very simple. We understand that, say over here, it is annual interest plus annual hedging cost plus upfront fees divided by number of years. Annual interest cost is very simple. It is 3.55%. So what will happen? It is 100 lakhs into 3.55% into 3.4 years, or we are required to do it on annual basis. So into 3.55% plus into 90 plus 100 lakhs into 4% multiplied with again 90 plus 100 lakhs into 1.2% into 90 divided by 3.4 years. So 100 lakhs into 3.55% into 90, that comes to 319.5 lakhs plus 100 lakhs into 4%, that comes to 4 lakhs into 90, that is 360 lakhs plus 100 lakhs into 1.2%, that is 1,20,000 into 90 divided by 3.4, that is 31.76 lakhs So 319.5 lakhs plus 360 lakhs plus 31.76 lakhs, that is rupees 711.26 lakhs. This is the way we can compute the answer. Please write down this answer. Next question. What is the cost of hedging in rupees term? So answer of the second question is very simple. Cost of hedging is rupees 360 lakhs per annum comma in total it will be rupees 1224 lakhs. 360 lakhs into 3.4 years. That is the way the cost of hedging will be calculated. Next question. If K Ltd pursue an aggressive approach. Dear students, the term aggressive approach is very simple for us to understand now. That you do not hedge, it becomes an aggressive approach. What would be the net gain or loss for K Ltd? If rupee currency is depreciating against pound by 10%, rupee currency appreciates against pound by 10% at the end of the 5 years, assuming the loan is repaid in pound currency at the end of the 5 years. So now the question is providing the information that if at all you are having an aggressive approach wherein you do not enter into the forward contract for the purpose of hedging, then in that case what you should do, then in that case, say what would be your net gain or loss, say for the decision that you have taken of not hedging. You are required to give answer in both the situation. The information is provided to us that the rupee currency appreciates, and if at all the rupee currency depreciates, we understand say simply the exchange rate. If at all the rupee currency appreciates, then in that case instead of 90, the exchange rate will be 81 rupees per pound, and if at all it is depreciating, then in that case the exchange rate would be 99 rupees per pound. That is 90 minus 10%, and over here 90 plus 10%. See what will happen, the one thing is very clear. If at all you are adopting the aggressive approach, then in that case you will be able to have savings of hedging cost. That is the amount that you will save, an amount of 360 lakhs. This amount you will be able to save because you have not entered into the hedging transaction. Okay. Now if at all the exchange rate is 81, so what happens, that say you have to pay at the rate of 81 instead of 90, because in hedging you would have paid at the rate of 90. So in that case you will be having savings of repayment of loan. What will happen, 100 lakhs into 90 minus 81. It means that so you will be able to save 9 rupees per pound into 100 lakhs. So you will be able to save an amount of 900 lakhs. Of course, if at all the rupee currency depreciates, then in that case you will be having additional payment which you are required to pay, 100 lakhs into 90 minus 81. It means that say you have to pay 9 rupees more per pound into 100 lakhs, that comes to 900 lakhs. So net savings slash cost. Okay, in the first case what will happen, use your calculator, 360 plus 900, you will be able to have the net savings of 1260 lakhs, and in the second case it is 360 minus 900, you will be having cost of 540 lakhs. This is the way you will be having so the net savings or the cost in both the cases. Sorry friends, over here the additional payment is 99 minus 90. That is additional payment. Please write down with paragraph. Over here we are considering that only for repayment of principal hedging is not done is to be compared with cost in case of hedging would have been entered upon. Full stop. So let us have a small summary of the entire question. We have been provided that say we want to do like some capital investment of an amount of 9,000 lakhs, and for that say we are going to take loan of 100 lakhs. So the exchange rate over here is also 90 rupees per pound. The time period of the repayment is 5 years, and an important and new information given to us is the average loan maturity is 3.4 years. Upfront fees 1.2%. The rate of interest for the loan is 3.55%. Of course, we understand that upfront fees is only for one time. Exchange rate is provided to us. Cost of hedging is given to us, which is required to be paid on annual basis. We have to ignore time value of money for the purpose of simplicity, and calculation is required to be made till 2 decimals. The first question is we are required to compute the cost in annualized term in percentage term. In that, interest cost 3.55, hedging cost of 4%, upfront fees is one-time expense. Dividing the same with the number of years, it is converted into annualized term, and that comes to 7.9%. Overall annual cost, the same thing what we have done earlier is required to be done over here once again. We just have to consider the amount. So the amount of the loan into rate of interest. So that amount of the interest will be calculated in pound currency term into 90, that is converted into rupee currency. Exactly the same for the hedging charges, and similarly we are required to consider it for the purpose of upfront fees. Cost of hedging is asked, second part of the question, very simple. In per annum term it is 360 lakhs, and in total 1224 lakhs considering 3.4 years. Third part of the question, in that if at all the company is not entering into the forward contract, the company is not going for the hedging, then in that case what would be the case? If at all the rupee currency appreciates, rupee currency depreciates is the question. If rupee currency appreciates means less amount of the rupees is to be paid to purchase a pound. So the exchange rate is 81, in which say you will be able to not only save the hedging expenses, but at the same time you will be able to make savings in terms of the repayment of loan, because per pound you have to pay 9 rupees less. So 100 lakhs into 9, you will be able to save 900 lakhs. So the total savings is 1260 lakhs. On the opposite side, savings in the hedging cost will be there. However, the cost increases this time, and so there will be a loss of 540 lakhs. That is what we understand.